Let's get to today's action with our market panel. Scott Wren of Wells Fargo Investment Institute and Vital Knowledge founder Adam Crisafulli. Adam, I'm going to start with you. Kashkari, we had a lot of Fed speak the last couple of days. Kashkari floated. He basically said he thinks 2 cuts, but floated the possibility that we could get no cuts this year. He's not a voting member. How important to the market and the sell-off we saw this afternoon was that versus some of these headlines, some of these reports that are circulating about Iran considering retaliation or some sort of action against Israel, or we'll call it flaring tensions in the Middle East?
Yeah, so I think, I think it's important on days like this to kind of separate out fundamentals from technical conditions. So I think technically you had a complacent market, you had an expensive market, you had a crowded market. All of that is the kindling for these types of real sudden, sharp moves lower on a day where there really, in my opinion, wasn't a ton of dramatically incremental news. Kashkari remarks were notable, but there were comments from other Fed officials that were kind of on the opposite end of the spectrum. So Goolsbee, almost said the opposite, whereby he wasn't concerned about recent inflation, and he still was kind of on track with 3 cuts for the year. Most Fed officials, even Powell yesterday, are still kind of conveying a message that the Fed is likely to move 3 times this year at 75 basis points worth of cuts. So I don't think it was so much Kashkari, and you actually did see Fed expectations move in a dovish direction today modestly. But the lack of a big real material rally in treasuries, I think, is insightful, and it suggests that, this really wasn't a dramatic fundamental reaction in stocks. It was more kind of just a technical move of a market that, like I said, has been kind of a little complacent, a little rich, and pretty crowded. Oil played a bigger role psychologically. You did have that big spike around 130. There were a lot of headlines out of the Middle East. I wouldn't say there was a lot of real dramatic developments, but certainly geopolitical tensions, not just in the Middle East, but in also Russia, Ukraine, and the move in oil, that's playing a role, not only on the inflation front, but on the consumer front as well. And, probably one of the more notable developments came in the morning out of Lamb Weston, where they talked about one of the reasons they had such a dreadful quarter was, softening traffic from their restaurant customers. And that's consistent with what we've heard from a variety of different retail consumer-linked companies over the last several weeks. That there does seem to have been a shift in the consumer on the downside. That's definitely going to be something to watch. Yeah,
we heard that from Ulta earlier this week, PVH. You could argue that you saw some slightly softer commentary coming out of Lululemon as well. Scott, You're cautious on equities here. How do you position yourself, especially when we're just over a week out from the start of earnings with banks? You got jobs report tomorrow. You got all this Fed speak, and now layer on geopolitics on top of it.
Yeah, Morgan, I mean, in my opinion anyway, I think the Fed speak that we've heard, which we've heard a lot, it's been from the same script. I didn't really hear anything different, whether it was what Powell said yesterday or Neil Kashkari said today. I think today was largely about geopolitical tensions, imminent Iranian repercussions, Israel putting their embassies on alert, oil going up. I mean, that's a big deal, and I think that's really what drove the market today. Of course, Fed speak always, has at least some influence. Tomorrow, we've obviously have a big number here, and if the number comes in the right way, which is not too strong for tomorrow, you could see this whole move today reverse. So I think in the meantime, you still have to think about valuations being high. You still have to think about, what could I do now? Well, you know what the high flyers have been over the last 12 months. It's tech, it's comm services. In our opinion, you should be trimming those positions back to neutral, because if you've been riding them, you're overweight right now. And you need to be looking at things like materials, industrials, healthcare, energy. Those are things, some of which have done very well in the last month or 6 weeks. Those are some things we think have some potential. So would we buy the S&P here as a whole? We would not. But I think there's some things under the surface that you can be doing. But overall, we do think after this huge run we've had off the October lows, it'd be nothing to cough up 5%, 7%, something like that. Today's reversal was nothing. 1.25% after the run we've had. So I think you have to be a little bit careful here. You have to look for opportunities. You have to operate a little bit under the hood. But overall, let's face it, equities aren't cheap.